And there it is, the closing bell at the New York Stock Exchange. U.S. stocks shook up the GDP report and rose today as markets rallied from sharp losses earlier this week. The Dow Jones ended the day in the green, jumping about 34,000 points.
The Nasdaq and S&P also had a good day. The Nasdaq climbed around 3%, and the S&P is up more than 2%. Joining us now is Matthew Luzzetti. He is a chief U.S. economist for Deutsche Bank. Matthew, thanks so much for joining us. Earlier this month, Deutsche Bank became the first major bank to forecast a U.S. recession. Then earlier this week, that prediction was updated to a massive recession. Then today, the U.S. Commerce Department reported that GDP declined for the first time since 2020. Do you think this is further evidence that a recession is imminent?
Sure. First, thanks so much for having me. I think what is important here with this morning's print is, yes, it was negative. We were down minus 1.4 percentage points. But the composition of that was really driven by a few items. It was driven by net exports and trade data, which has been quite volatile. It was also driven by inventories, where we saw a bit of a destocking, and actually government spending. We tend to like to focus on those measures of private domestic demand, consumer spending, housing, business investment. And when you do that, those numbers are actually quite strong, growing 3.7% annualized when you look at those three items together. Net exports alone subtracted more than 3 percentage points. So no, we do expect that we're going to see a recession by the end of next year, but this was not the start of it. We do expect that you're going to continue to see relatively solid growth throughout the course of this year, around 2% on average over the course of this year, and that the economy should bounce back in the second quarter.
And so what are some of the factors that your bank is watching it's led the bank to believe that this massive recession is imminent?
Sure. So for us, really it is all about the inflationary pressures that we are seeing in the economy and the likely necessary response that we have to have from a monetary policy perspective. And so it is actually the strength in the economy, the strength in the labor market, which we saw again today with jobless claims remaining near record lows, the strength that we've seen in the labor market with the unemployment rate at 3.6%, measures of labor market slack basically at historically tight levels, and the fact that that is feeding into broadening wage and price pressures, which suggests that the Fed has to get more aggressive. We expect they're going to be more aggressive next week, raising rates by 50 basis points. We expect they're going to follow that up with 2 more 50 basis point rate increases in June and July, and that they'll have to bring monetary policy to a restrictive stance by the middle of next year. Our baseline estimate is a 3.6% Fed funds rate, and that is kind of a necessary monetary policy response really to get inflation pressures back down. The byproduct of that, I think, will be our baseline is a mild recession towards the end of 2023, with risks that it is more severe if inflation pressures really do not subside at all.
Great. Matthew, is there anything U.S. officials can do at this point to prevent a major economic downturn? And if so, what?
It's a very difficult one, and it's a very difficult one because the typical things that you would anticipate to prevent the downturn would be providing support for demand. And really it is demand, an overheating economy. It is too much demand relative to supply that is creating the issues that central bankers are dealing with today and that policymakers are dealing with today. It's creating the price pressures that we're seeing, several decade highs for inflation, very rapid wage gains. And so the typical policy response, which would be easing policy or providing some income support, is not what is needed right now. On the other hand, things that can help to alleviate supply chains would be helpful. Things that would help to bring people back into the workforce would also be helpful. But I think ultimately we don't think that price pressures are simply going to subside due to what's happening on the supply side of the economy. Really what will ultimately be needed will be tighter monetary policy. Fiscal policy will tighten this year relative to last year, and that will be the ultimate source of the downturn that we anticipate next year.
All right. And again, ending the day in the green today, Dow sitting up about 600 points. Matthew Luzzetti, thank you.
Thank you.